Good morning, everyone. I'm Greg Faranello, head of U.S. rates for AmeriVet Securities. Welcome to Monday Minutes. Let's try and block and tackle here through a very difficult time for global financial markets off the back of the spread of the coronavirus. Last week, we expressed a view that we thought the funds rate should come down, and the funds rate should come down sooner than later as the spread of the virus became apparent. And it's been interesting to us because throughout this entire period, especially the beginning of 2020, the markets were behaving very much as trying to compartmentalize the risks in the marketplace as the virus became apparent as a China-only issue. This is clearly not a China-only issue, and that facet is now, unfortunately, becoming very apparent. Let's talk briefly about the Fed, and let's talk about Friday. Fed Chairman Powell coming out with an announcement showing some leadership, very much necessary for the markets. There was expectation of an immediate hike intermeeting this morning. When you look at the Fed speak, in particular, if you look at Dallas Fed President Kaplan, he was extremely measured. And he ended by saying that he'd be prepared to go into the March meeting ready and willing to take steps if necessary. He talked about the economy. He talked about having conversations with CEOs. He talked about inflation expectations. He talked about financial conditions. He talked about credit spreads. So in general, and if you look at the other Fed speak, the Fed speak coming out of Friday in conjunction with Powell's announcement was actually extremely measured, thoughtful, and reflective of the severity of the current situation. We look overnight, we had the Bank of Japan. You look at Italy over the weekend, a fiscal stimulus package. This is very much a scenario in our view that's going to require a combination of both fiscal leadership, which is first and foremost to fight a crisis of this nature, and also monetary stimulation to try and calm the markets down over time. And what we're seeing short term is clearly a coordination on a global basis of efforts along those lines, which we think will be necessary. And historically, we've seen other pockets of time like this that have required a global and coordinated thought process. Let's look at context. Let's look at levels. We don't have a crystal ball in terms of where markets will ultimately go. And certainly, unfortunately, it looks like the virus has the potential to spread a little bit more before getting better. And we need to be reflective of that. So if we go back to the period of 2017, we had a nice run up in the equity markets, mainly off the back of the outcome of the presidential election in 2016, a run up in equity markets in 2017 off the back of the tax cuts and fiscal stimulation. Then if you look at the period heading into 2018, that's where the Fed did most of their tightening. So from the end of 2017 up until December of 2018, the Fed actually tightened 200 basis points. If you look at the period of 2018, you look at inflation expectations, you look at forward inflation expectations, 5-year forward, 5-year inflation expectations, we were trending well above 2% for a persistent period of time, and that's when the Fed did most of their tightening. Heading into the latter part of 2018, in particular December of 2018, we had an extreme correction in equity markets off the back of the perception that the Fed had actually gone too far. And in fact, if you look at the dialogue from the Fed throughout most of 2019, and in particular the summer of 2019, Chairman Powell's semi-annual testimony, he actually admitted that the Fed had been running a little too tight in the course of 2019. So we have an extreme equity correction at the end of 2018 against the backdrop of the perception that the Fed had actually gone too far. That led to the global central bank pivot, the Fed in general, in January. Then the Fed actually had their mid-cycle adjustment, and we saw equity markets continue to trend higher. And then unfortunately, we had the repo hiccup in September, which equated to the balance sheet expansion of roughly $400 billion in extra liquidity provided by the Fed in the form of T-bill purchases and repo operations. Now, the perception of those operations has been debated over the last couple of months, but the reality is pretty clear. If you look at the performance of equity markets from September, October of 2019 through the beginning of this year, the returns are quite obvious and pretty clear. So now we have an extreme situation with the Fed potentially moving the other way, likely to move the other way. So the point here is when you look at the absolute levels in equity markets, you look at levels in credit markets, The levels over that time frame really haven't changed all that much. But the reaction and the behavior in markets in this period of time is clear. They are pivoting very dramatically off of central bank policies in both directions. This is something the Fed has talked about in terms of financial instability, and they've been pretty clear in terms of their own mindset. But when you look at the market behavior, you look at the impact that this potentially has on consumer behavior and financial conditions, we think the pattern is very clear. For other context, 23,500 in the Dow Jones to 26,500 was a range that we had for quite some time. Taking out the extremes that we saw recently with the all-time highs and taking out the extremes that we had back toward the end of 2018. What's priced into the market right now? Well, there's still a slight bit of expectation that the Fed could potentially come in here and do something intermeeting. What's actually priced in through the end of June now is roughly 100 basis points of total liquidity in general from the Fed, in conjunction, obviously, with other central banks now coming out fairly publicly and saying that they will support the markets in here. The reality is, over time, the Fed has spoken consistently in the course of 2019 about the zero lower bound. And with the effective Fed funds rate about 150 basis points above that, the risk of eventually heading back to that zero lower bound was clearly on the Fed's mind. The catalyst in general, when looking at it, last year with the tariffs, was global economic weakness. Now, certainly no one had the coronavirus on their radar, and no one could predict this would happen. But the likelihood now that we start to move fairly aggressively toward that zero lower bound has increased. The big difference in this global economy over the course of the last year and a half has been the U.S. consumer. And we drill down more specifically right now, this is no longer an issue. As the coronavirus now has infiltrated the United States, this is no longer an issue where the Fed can point the finger abroad and say that the risk to the U.S. economy is minimal. This will undoubtedly constitute, in the Fed's words, a material reassessment of the outlook at a minimal. To date, the data in the U.S. has held in fairly firm. This Friday, we get the employment number, but this will be more about the outlook going forward than anything else. I'm Greg Faranello, and this is Monday Minutes.